Good evening, good evening. We're going to give it a minute or so just to let everybody's audio get connected. Let our stragglers join in. I hope it's warmer and less snowy where you are. Uh, had 6 inches today, 6 inches yesterday on the driveway and sidewalks. And of course, I couldn't get my snowblower to start. Little weekend project, try to revive that beast. Oh, my aching back. 40 and no snow, not terrible. 21. Expecting 4 to 6 more inches over the weekend. My son is in Billings, Montana. He said on Saturday, it's going to be a high of -9. A high of -9. Low in the low 20s, in the negative 20s. Larry, you're in Fort Worth. Love it. I'm a Texas guy, born in Wichita Falls. My brother's in Euless. My parents were in Grapevine and Colleyville before they passed. I grew up in Richardson a couple of different times, so I'm very familiar with the area. Okay, there you go. Love it. The skiing is good. The snow, they've been getting pounded. My daughter bought a season pass for the first time. She's snowboarding. I can't wait. My kids have been playing soccer for literally 15 years. I've been just dying for them to stop so we could start snowboarding in the winters. All right, let's get into it. Welcome to the Market Watch Group, Trading Foundations Technical Analysis Part 2. If you missed part 1, go back and watch. We're gonna be diving into some deeper concepts. But in part 1, we looked at the philosophy, the mindset. We start with that foundation of technical analysis. Is why are we deciding price charts? And technical analysis, and what are we accomplishing? Well, we're trying to project. We're trying to understand patterns that represent the behavior of supply and demand in order to understand when there is more of one than the other, and it generates expectations of momentum and follow through, and now we start to project price action, and we make predictions. We trade that, and we find stops and targets, time frames. We get reward to risk ratios. Everything about how we build and manage the trade comes from the charts. Well, that's what we use to make decisions. If you decide you want to incorporate fundamentals to help sort, filter, and evaluate companies' underlying strength, right? Whether it's valuation ratios or growth rates or whatever it is, great. Add that in. Even if you started with that, you still need something that's going to help you actually make the decision of when do I pull the trigger? Where do I put my stop if I pull the trigger? There. Where's my target? What's my reward to risk? Is that good enough? Those are the questions that we have and want to answer. And that's why we're here. My name is Scott. I will be your host. Here are our disclaimers. Always remember, please, we are not advisors. This is educational and illustrative in its intentions. We will be talking about trades, and the date is coming up quickly. This weekend, I have some time. I'm going to send out a couple of surveys. we are putting the finishing touches on the format and the structure of the alerts, where I'm going to start spitting signals at you. I told Press, he's not here. I told Press that I would absolutely get on Discord and let you know if I took a hedge. I didn't. It was an interesting day today. A little surprising. Anyone else surprised today? We said above 3.2, it's going to sell off. It started that way. And if you're like me, you probably had some profits that you're like, yeah, I'm going to go ahead and take those. And they may have recovered a little bit. You may have held on to some. Still looks like a hanging man when you look at the SPY. And obviously with the technical analysis, we're going to look at some charts today. So very interesting day, I thought. Here's our agenda, intro and recap. So we're going to talk about what did we cover last time? Then we're going to get into technical indicators. Remember, my definition of technical indicators is simple. Is it calculated? Is it calculated? Right? So moving averages, average, calculated. Oscillators, you have a range from 0 to 100, calculated. Keltner channels, calculated. Bollinger Bands, calculated. Heikin Ashi candles, calculated. Then when we think about technical indicators, we break them down into different categories because they do different things. Trending indicators are just that. They help us to establish trend and see who's in control. They work great in a trending market. A moving average crossover system, simple. Oh, if the 20 crosses the 50, and then when it crosses back down, but it lags significantly. It does phenomenal. If you catch a trend, it'll do great. If the market goes sideways, it'll chop you up and spit you out. What does well when the market's sideways? Oscillators do phenomenally well. The problem is we're constantly shifting from sideways to trend, sideways to trend. Now it's consolidating. So what's our solution? We try to incorporate both. I have a 50-day exponential moving average, and I have a 7-3 stochastics. So I can see a little bit of both. I want that perspective. Once we have that in place, we're going to start talking about watch list criteria, right? So now that we have some indicators, we start to use them to define, well, what do I need to see? I need it to be above its 50. I need to see volume above 2 million. I need to see, right? These are the things I need to see. Then we have setups and triggers. What does a setup look like? What does a trigger look like? And when you have a sense for those things, now you can actually go in section 3. We'll be doing that together next week as a group. Section 3 in your trading plan is developing and defining your technical rules. Lastly, we're going to talk about how we incorporate risk management with technical analysis, summarize it, wrap it up, put a bow on it. Full send. Love it. Comment came in from Paul. He said, good evening. Now, is that Barnes & Noble? I love Barnes & Noble. God, I love it. Get a coffee, walk around, look at books, love it. He said he picked up The Complete Trading System by Casey Stubbs. God, that title sounds familiar to me. The author, not as much, but the title does. So far, it's been a great book, coincides and reinforces what you are teaching. I mean, if it's reinforcing what we do here, then I love that book, Paul. He says it answered questions he didn't realize he had. Would recommend for all. Thank you. Love it. Mark it down, everybody. You know what I've decided? We need in our welcome doc, we need a reading list. Yeah. I have an old reading list it breaks down like options versus technicals versus trading psychology versus peripherals. I would add that to it. Paul, I may ask you to remind me one time because I might forget, but when I produce the list and you see it, make sure you remind me. Let's dive in, everybody. Intro and recap, technical analysis. What are we doing? We study price, and a supporting indication is volume to create patterns, to create indicators, and ultimately to make predictions about future price movements and market trends. Steven just threw a dig at me, a zinger. He said, Paul, he needs a lot of reminding. I do. I'm not going to lie. He's not wrong. He's not wrong. Always I have the best intentions. Time just gets away from me. It's coming back. My kids are gone. I've been having to shovel too much snow. That's the problem. Okay, historical price and volume data. Those are the components, right? I mean, there are other things people might look at. I'll tell you right now, all I care about is price and volume. That's it. Price and volume. We're trying to make forecasts. Where prices may go, how long may they take? What are we using? Past behavior. Past behavior. Why? Because people and traders do the same thing over and over and over and over and over and over. We have a herd mentality. Here's a book. It's on the list. It's called Extraordinary Popular Delusions and the Madness of Crowds. Huh? Phenomenal title. It talks about historical bubbles. Talks about options The beginning of options in Holland in the 1600s, when a tulip bubble, one tulip bubble would be at an inflation adjusted rate of about $2,500. One tulip bubble. You don't even know if it's going to open. Right? Madness of crowds. Beanie Babies. You're like, oh, how could those people do that? Let me show you some Beanie Babies people paid thousands of dollars for. Let me show you some NFTs. Let me show you a cartoon monkey. Yeah? A cartoon monkey that somebody paid $5,000 for. It's worth $20 now. Extraordinary popular delusions and the madness of crowds. Some of the core tools we use to make decisions include trend analysis, support and resistance, candlesticks, candlestick patterns, volumes, etc. Okay, technical analysis or technical indicators. Technical indicators are mathematical tools. Mathematical tools. If it's calculated, it's an indicator. Why do I make a distinction? Because my premise is always price action analysis. Trend itself, it's not really mathematical. It's visual. We're looking at it. Do I have higher highs and higher lows? I guess you could technically say, well, I'd have to calculate it to be sure. I don't have to calculate it. I can see it. I can draw my lines. I look at candlesticks, open, high, low, close. I look at volume. How much volume did it have? I actually had a time, and I've had many people do this, where I say you have to take every indicator off your charts and make decisions. I let them do paper trading. I mean, I let them. But I mean, saying, look, for the exercise, I'm like, get rid of your charts. What if you only had price? Because if you can't make decisions with only price, adding more isn't going to help you. But if you can, then you'll start to see the subtleties and the nuances and the consistency that indicators can give us. They assist us in making informed decisions with objective, data-driven insights, reduce the emotion. If you're ever like, oh, my gut tells me, oh, does your gut tell you that? Your classically trained gut? There's a wide array I'm going to go show you in just a second that help us to identify trend, identify momentum, detect overbought, oversold conditions. Our objective is to integrate these tools into strategies for entries and exits, stops, managing risk. Let's pop in here. What do I have for indicators? I do have implied volatility, but remember, that's an options indicator. I have a 7-3 stochastics with my overbought and oversold range set at 70 and 30. Remember that I can change everything about an indicator. Now in Thinkorswim, we're up here in this little lab bottle, this beaker. You can see what I have. And anywhere you see a settings cog, I can change it. I can say, oh, I can make this 100 or 200. I could give it a displacement if I wanted. I could put breakout signals. And you might think, oh, that sounds great. What is a breakout signal? That's when price moves above it or below it. It's not that great. That's why I don't have them. I can change the color. There's a lot of things that I can do with it once I have it on there. I really don't need to do that much, right? I've got simple moving average on the volume. So I have another moving average to show where's above average and what's not. Nothing this week is above average, I can tell you that. I have my stochastics. Overbought and oversold. Where are we now? We just got into an overbought situation and it's starting to pinch, to turn. And there's that hanging man. Now, if all I showed you was that candle, and I said, what is that candle? And you said hanging man, I'd be like, you're right. And if you said that's a hammer, I'd say you're right. What's the difference between a hanging man and a hammer? Where did you find it? If you found it here at the bottom, after a pullback, that's a hammer, hammering at a bottom. If you find it here after 4 days going up at resistance, it's a hanging man. Context matters. Yes, context matters. Why a hanging man? Well, because it appears as if it's starting to die, right? The momentum is starting to die. I can change by default. A stochastics is a 14.5. I went 7.3. Why? Well, because I want information sooner. I don't want to wait. I want that information. Give it to me. Could I make it even shorter still? Well, yes, but then if we shorten it too much, then we lose confirmation. So it's a balance between confirmation and effectiveness. One of the most effective technical analysis tools, provably, is a 200-day moving average. If that's all you traded, you would actually do pretty well. But so then why am I not doing that? Because that's not really a trader's perspective. I believe I can beat that. I don't want to only put trades on when I break above the 50. That's more of a position than a trade. And I'm a trader. So that's why. Okay, let's keep going. What else is available to me? All of this over here on the left side. These are all technical indicators. You can see how many there are, right? Just one after another, all the way down. I'm in the L's, now the M's, a lot of M's. Here's the O's, the P's. Oh, I mean, just look how much there is. I always laugh when somebody brings up an indicator and they're like, oh, you haven't heard of that? And I'm like, have you seen an exhaustive list? This isn't even exhaustive. There's more than this. Okay. What's the bottom line? The bottom line is no matter what indicators you choose, they should be quick and easy to validate. Okay? If you're like, hey, well, should we look at this? Put it on. Find the places that you want to trade. Then draw a line and say, oh, you know what? I would have liked to have gotten in right here. Would this have helped? Yes. I would have liked to have gotten in here. Would this have helped? Yes. I would have liked to have gotten in here. That was a tough one. It did turn up, but it was overbought. We talked about that. I would have liked to have gotten in here. So are they always going to work, these signals? No. But I need to know that whenever there's a move I'm interested in, I'm likely to catch it. Now I have to be prepared to catch things that I didn't want to catch too. But this is what's important to us. Can you provably establish that there are moves that occur after your signals? Now, this one may be done, maybe not. We don't know. We got to see what tomorrow brings us. We do have a 3-day weekend. Don't forget MLK. Market's closed. This seems to be hitting some resistance. So what are the technical tools I'm using to establish this and help me to trade? I'm starting with trend. Overall, the trend is good. I'm trying to give my bullish trades as much room as I can, but I don't want to give back unnecessarily. I look at support and resistance and I say, oh, look at that. We're right near this old resistance level. It would sure be nice if we had some volume to help push through it. And if not, it's a little harder. Now, all of a sudden, I've got this hanging man candle here. Doesn't look great. The stochastics are starting to pinch. If I don't get a candle tomorrow that busts this thing out, I'll probably shut down remaining bullish trades and wait for the next consolidation. That's what I want you to feel comfortable doing with your charts and your technical analysis, is looking at it and then making enough of a prognostication that you can establish, are you going to take new trades? Are you going to continue holding trades? Etc. Bob said he closed Microsoft for a nice profit today. Good. If anybody was in if anybody was in Google or Meta, you probably took some profit there too, right? So yeah. All right, let's keep going. Oh, my SUU. Nope. What am I looking for? My presentation. Oh, I must have stopped it. Sorry. Let me get this back up. Okay, trending indicators. Trending indicators are essential tools in technical analysis to help you identify the direction and the strength of market trends. So what are some of the indicators that we're going to use there? Moving averages. And we have simple, we have exponential, we have weighted, a lot of different moving averages. I prefer exponential for price, simple for volume. It's just what I've come to. Do I have some mathematical conclusion that says I can demonstrate provably that one's better than the other? No. And that's often the case. How you use an indicator is just as important as the indicator you choose. I've had success with indicators, and when other people try to use them, they're like, I just can't make it work. Okay. I don't know what to tell you, right? My perspective, the way I see it, the way I use it, it works. If it doesn't for you, great. Then you find what does. That's the point here. You might have to play with this a little bit and say, well, do I want a 20, a 50, 100? Put them all on. Which one helps the most? Right now I have a 50. If I break the 50, I add the 100 and I add the 200. Other than that, if it's sitting above the 50, great. No reason to include the others for me. Once I break the 50, then the others start to have a greater potential to have relevance, and I want to watch them now. We also have Bollinger Bands. Now you're adding volatility, right? Now you're adding 2 standard deviations. You have Keltner channels, which are similar. Parabolic stop and reverse. Each has different characteristics to help you see, is the trend in place? Where are we in the cycle of the trend, etc. Now, to effectively use trending indicators, it's very important to interpret their signals. Oh, I just lost my fancy microphone. Oh, I got it back. Okay. Okay, you might have heard the audio change for just a second, but we're back in business. What are we looking for? We're looking for the slope of the trend lines. In a trending market, you'll see the 50 can be a beautiful support level because it comes down, hits it, bounces higher. And as the moving average moves higher, it bounces higher, and it's helping us to understand if that trend is continuing to show that strength. If it breaks the moving average, then we're like, oh, that's not good. That's information that's important to us that we're going to use to slow down and wait for something else to now develop, or to ease up on our trading until we see the situation get more clarity. We want to incorporate trending indicators to help us first and foremost confirm the trends, right? If I came to you and I'm like, my market posture is a 6, it's very bullish, and then you looked at the moving averages, they're just going sideways, you'd be like, well, why doesn't the moving average show something better than that, right? Let me pull this up real fast here. If I were to add a trending indicator with volatility, a lot of people these days are bringing Keltner channels into play. I actually would prefer Bollinger Bands. So let me just show you real quickly what that would look like and how we would put that on. So I would come over here, I would type in BOL for Bollinger. I'd stick it, I'd add it, and I'd say, okay. And that's it. Now, I'd probably want to go in and change this line here and make it a different color so that it stands out. This green line is still the moving average. Is the moving average going up? Sure is. These are the upper and lower bands of Bollinger Bands, and this is a 20-day moving average plotted in the middle. That's put in there as part of Bollinger, right? And so you can see, okay, now, as I look at that, do I think, man, that really clarifies things? No, that's why I don't have it on my chart. I'm not saying it's wrong if you do. What I'm saying is we're all going to have different charts. If you look at this and you're like, oh my God, Scott, I've never seen a chart look so good, then you should add it. If you look at this and you're like, I'm not seeing why people love this so much. It just expands, it contracts. That might be some of it. Contraction. When you see the volatility starting to tighten up because you're thinking, ooh, eventually it's going to pop out of that. Great. I will use it that way sometimes, but I just don't use these very often. I could come in here and I could change that out for a Keltner channel instead. So, and this is what I want you to do, is I want you to explore and be like, right, start with what I have. Let me spell Keltner correctly. Kelt studies. Why is that? Keltner channels. Add selected. Okay. And you can see, these are a little different, right? Still have 3 lines. I could probably make this a little bit more displacement. Okay. There we go. And now you'll be like, you know what? That doesn't look too much different. It just doesn't expand and contract as much. I agree. These don't help me make decisions. That's one of the first things I do when I work with someone individually. I make them show me their charts, right? And most of the time I see a bunch of stuff and I'm like, what are you doing with this? Well, I kind of use it to sort of do this. Nope, gone. No kind ofs, no sort ofs. What exact information does it give you that lends itself to making decisions? And if you can't answer it, cut it. Get rid of it. And this is the problem a lot of people have with technical analysis is they think technical indicators will show me the way. I'll put together 3 different indicators of a couple of time frames and bam, crystal ball. Nope. There is no crystal ball. That's not going to happen. So, stop trying. Then we end up in this constantly getting distracted by shiny new things where we read about this indicator and this guy says it sounds so good. And believe it or not, what does he do? He shows you a couple of charts where, my God, look how well it worked. And it's just like, give me 7 minutes and I'll go find 18 stocks where you're like, oh my God, if I would have used it there, I would have just gotten my hat handed to me. So there will be some trial and error in your technical analysis development. Put some things on. If you like it, keep it. If you like it, but it's a little too slow, go speed up the numbers, shrink them down a little bit. If you like it, but it's a little too choppy and uncertain, slow it down a little bit. Make the numbers bigger. You got to just test it a little bit. YouTube is a great source to help you work on this process. Okay, so that is your trending indicators. What's next? I believe we're on to oscillators. Oscillators are a subset of indicators, of technical indicators used in technical analysis to evaluate momentum. Is momentum going up or down? And identify overbought or oversold. I mean, you can see that's exactly what we had with our stochastics. Some of the key oscillators people will use include RSI. You've probably heard of that one. Stochastic, that's what I have. MACD, we talked about that a little bit on Tuesday. Moving average, convergence, divergence, which some people are like, oh, it's a hybrid. They use moving averages and they use an oscillator. It's better. It looks exactly the same, right? You can't just be like, it's better. Show me on a chart that it's better. Pull up a stock, show me a 7-3 slow, show me the MACD, show me where it's giving me a signal that's better. And usually you can't. It's like, okay, look, it should be so quick and easy for you to establish and prove which indicators you're going to use and at what time frame. Promise you, if you do the work, it's going to stand out to you. You want to interpret oscillator readings by considering overbought and oversold, spotting bullish or bearish divergences, looking for crossovers, and finding your entry and exits. I'll tell you what, I actually don't like crossovers. I like turns. I'm not necessarily waiting for this to get on the other side to confirm that it crossed. I'm waiting for this to turn. Oftentimes it's just a pinch. Like here, just a pinch. Cross the next day. I want this day. Right? There's the cross, there's the turn. Or excuse me, there's the turn, there's the cross. The cross is oftentimes a day later. Sometimes they're the same day. I'm looking for this to be fast. I want to catch it right as it bounces off support. That's my objective. I've already found an uptrending stock. It's making higher highs and higher lows. It's at a higher low, which I believe is a new support level. All I need now is confirmation that it's bouncing off support. And that's what the oscillator does, is it brings that last piece of confirmation. And that's how I want to develop my trading rules, explicitly defining what has to be there and what has to happen for it to actually trigger an entry into the trade. Okay. What are the oscillators? So let me show you that. So we talked about MACD, stochastics. I'm going to add a MACD. A MACD, add selected. I'm going to move it up. Move this down. And I'm going to say, okay. Now, you can see here, this is where it turned. You can see, you can't really see this one, but I'll tell you right now, I would actually, let me go back in. I'm going to change this to an 8-17-9. That's the standardized short form. And you're going to see these turn, they bottom at the same time. They turn at the same time. I like stochastics better because I like to say, hey, this is in a good zone. It's overbought, it's oversold. I don't think this does overbought and oversold as well. It can't be contained as well, right? You might see really big ones and then smaller ones, whereas I like to see this have overbought and oversold. That's my preference. Does that mean mine's better? No. Some people love MACD. Fabulous. I'm not going to try to convince you not to use something. I'm not going to try to convince you to use something. I'm going to try to convince you to establish and validate whatever indicators on your chart, there should be such a very specific reason why. And if you don't have that reason, yank the indicator. It's not helping, it's hurting. It's just putting white noise into your decision-making process. Okay. What's next? Please ask questions as we go. Watch list criteria. Now that we start to have some things in line, we need to make sure we have criteria that we use to put on a watch list. Now, you've watched me do it. What do I look for? Essential technical parameters like A, it's above the 50-day. B, it's above the 100-day. I actually don't care if it's at support or resistance when I put it on my watch list. I don't care. I'm gonna actually diverge from my own slide here. If it is high liquidity, minimum of 2 million shares trading volume, that's technical. If it is above the 50 and above the 200, that means it's trending up. And if it is in the leading sectors, it's worthy. I'll put it on my list. Absolutely, I'll put it on my list. And that might not seem like much, but I'll tell you what, when the market's good, we might have 50, 60. When the market was hard in October, September, our watch list was down to like 18. Nothing was there. You want to have a systematic monitoring and review process for the watch list. I do mine weekly, where I assess the technical factors and adjust as necessary based on changing market conditions. This last part is super important. That's what we just said. Take into account the sectors. Make sure that they align with your sector analysis. Sector analysis, that's technical. What are we doing with sector analysis? We're taking the ETFs of the broad sectors and we're putting them on a relative strength chart, which means they all start at 0. And then we look at so we look 200 days back, start them at 0. Where are they now? Look back 133 days. Where are they now? We look back at 66 days. Where are they now? 22 days. Where are they now? It's all very much a technical process. And after that process, we know what sectors we like the best. Once I know those sectors, that's the last element of my watch list criteria. Setups and triggers. Okay. And this is something we're going to be working on next week in our trading plan development. We need setups. We need triggers. So what do we need? Well, you need to select the relevant tools. Are you looking for indicators, for patterns? Kind of both. What's the pattern? Higher high followed by a higher low. What's the indicator? Still above the 50-day moving average. What's another indicator? Stochastics down in an oversold position. That's a setup. If that's what I have, beautiful. Not going to have a lot of that right now on our watch list. Most of the things we're going to see have moved for the last 4 or 5 days and they're actually up. We might have some things though, a little bit out of the financials who are going to start reporting earnings tomorrow morning, mind you. We want to clearly outline trade entry and exit conditions, specifying when to buy, sell, or exit a trade based on technical analysis. So what's the last piece? You have the setup. What are you waiting for? Buyers right now because it's bullish. A setup for bearish trade would be the exact opposite. Downtrend, pushing up to a lower high, below the 50-day moving average. Stochastics is overbought, waiting for it to do what? To turn. In that case, we're waiting for the sellers. Once the buyers in a bullish trade or the sellers in a bearish trade convince me, I'm ready, I'm in, let's go. So we can use confirmation signals from multiple indicators, which might be a candlestick and a stochastics. That's what we use the most. Do I have a candle that indicates price and has my stochastics turned? Confirmation. But mind you, we'll also anticipate trades where if we only have one in place, we'll rely on the bullishness of the market and still go ahead and say, that's valid. We'll take that. We want to make sure that we're establishing stop loss and take profit levels based on technical analysis. What am I using? I'm using support and resistance. Some people use things like ATR. I'm going to put my stop loss half an ATR, 2 ATR. Parabolic stop and reverse. People use that for stops. Moving averages. They use that. I like to use price. Where's my support level? I'm going to put my stop about 0.5% below that support. If I have too much confirmation already, I'm going to put my stop loss below yesterday's Heikin Ashi candle. These are very specific reference points created by technical indicators. The only reason I'm confident with them is I've used them long enough and validate them validated them over years to say, yeah, this is what I use. That's what I want you to get to. Certainly feel free to piggyback with me in the meantime. But we have to make sure that when we establish a stop, a target, it's got to be based on something. We can't just be like, well, I hope it gets up to 98. Yeah? Do you hope that? So this is going to help you to specifically develop technical trading rules. What are your trading objectives? Including your rules, your routines, your risk tolerance, your timeframes. All of that's going to be put into your trading plan. I'm a trader. I'm a swing trader primarily. I'll speed up if the market tells me to speed up, usually when volatility is risen. But other than that, I'm going to stick to a basic process. I'm going to do it over and over again. My charts, my time frames. A 5-minute chart has no bearing on my swing trades. Just like a daily chart has no bearing if I'm day trading. They're just not relevant time frames. So I have no problem with you changing time frames to gain perspective, but don't do it arbitrarily. Why? Make it deliberate. Why are you looking at this instead of that? Why an hour instead of 2 hours? If it's not specific, either stop doing it or do the research so that it can become more specific. We want to evaluate the effectiveness of our trading rules. We can do it through back testing so that we can look back and be like, if I would have done this, find 10 signals. How would you have done on those 10 signals? Do not fall into the trap of retrofitting where you're like, oh, you know what? I actually don't think I would have taken that trade because if you look here, the day before the volume just was a little fun. Like it's just, it's amazing how people will do that. I'm actually looking to find these days when I back test, I'm really looking to find where it's wrong, where it's like, oh God, oh, that would have been ugly. How can I avoid that? That's what we have to be doing when we're evaluating and validating technical analysis is don't try to like retroactively hindsight bias and be like, yeah, I definitely would have taken this one. Make sure your rules are explicit enough that you can be like, yeah, I would have had to have taken this. And I definitely would have lost money here. Great. That's gonna happen. If you think you found a system that's just right 10 out of 10 times, I promise you, you better look harder to find what's wrong with it because the market's going to show you what's wrong with it very quickly. Risk management, obviously, risk management is tied directly into our technical analysis. We develop stops through technical analysis. Stops help us to determine position size. We develop targets from technical analysis. That allows us to establish reward to risk ratio to make sure that it achieves a 2-to-1 or 3-to-1 minimum. We basically utilize previous pattern behavior to help make sure that whatever your target is and whatever your time frame is, it's validated because it's happened at least twice before. If you're basing off of one move, if you're like, man, this one move was phenomenal, and I'm looking for that again. It was one move. If you see a move that happens 3 times in a row, and you're like, this is what I'm looking for. I'm looking for $10. I'm like, why? Well, because from here to here, it moved 10. And then 3 weeks later, it moved another 10. And here it moved 11. Great. 10 sounds perfectly reasonable. If it moves 10, then 10, then 11, and you're like, I'm looking for 15. That doesn't really sound reasonable. If you're putting stop losses just right up underneath the price, you're going to get slapped out of trades. Right? So it has to be reasonable. Where's your stop and is it a reasonable level so that you don't just get picked off before the trade can actually move? Very helpful for risk management. Summary. Technical indicators are everything. Technical analysis is everything. I say that I'm a price technician first and foremost, but my indicators are always there. I'm always including them. I want quantitative and visual insights to understand trends, momentum, potential. I want to make sure that every decision I make is informed, deliberate, and reasonable. I need very specific rules for setups, for triggers, for trade entry, for establishing exit points, for when to adjust, when to take profit, when to move my stop. All of that's going to come from keeping my eye on the charts again and again and again. And lastly, my risk management, it's everything. If you haven't established where your stop would go, you have no ability to control risk. Your risk is not under control. You need a stop. At least it has to be mental. You don't have to set a physical stop. You have to have a line in the sand, and you have to use that line in the sand to quantify what is worst case scenario. And you have to use worst case scenario to position size and to establish reward to risk. Anything else is diluted. It's not based in reality. Okay. Woo, I left you 3 minutes for questions. Feeling very generous today to leave 3 minutes for questions. That may be one of the most amount of times I've ever left. What are your questions? What are your struggles with technical analysis? Why is this coming up here? Sorry. Let me bring some charts back up. Sorry for the cough. It's still lingering. I can't seem to shake it. Well, is everybody feeling good? Let's take a look at the VIX then. Technical analysis, go into the VIX. What does the VIX tell us? Okay, now look at this. Our low here, 12.37, 12.38, 12.37, 12.38, 12.36. These 3 days, we were within I'll call it a penny, but it's not really. And then today we got to 12.35. So we got to the low. That means that if we turn from here, it's not a higher low. That means that my VIX signal is not going to trigger. Does that mean I'm not going to hedge? It depends. I don't have much bullish left. I've been taking profits. Still have some. And if I still have some tomorrow, then I might hedge for the 3-day weekend. We have a 3-day weekend. Don't forget. Is there a chance I decide to speculate for just a quick, like, hey, this, it's not giving me the exact signal. But would I still possibly snatch a trade here? Maybe. Comment came in. Bob said, I've noticed that most of the time you use a bounce to trigger the trade. I've seen a lot of traders do the same. I was anticipating too much. The bounce really helps. Good. Yeah. I don't love breakout trades. I feel like they fail more than they continue. So I feel like, you know what, when it breaks out, I'm just going to wait. And when I wait, it'll eventually consolidate. I might have to watch it go up 2 or 3 more days, sometimes only 1 day. And then it consolidates. And when it consolidates to a higher low. And then I get a bounce trade. So yeah, I really tend to do, I'd say 80% bounce, 20% continuation, 0% breakout. I just don't trade breakouts. With the VIX this low, is it a good spread trade? With the VIX this low, you're looking for Vega positive trades. Because from here, the odds of it going lower, we've only been like lower for like a few days and only marginally lower, versus the odds of it going higher, I would say are significantly in the favor of higher versus lower. So I'm more inclined to take Vega positive trades. That would include buying options, buying calls, buying puts. That would include calendar spreads. We've been talking about those. We'll probably look to do one tomorrow. I may put it on in the morning and show it, but calendar spreads, perfect in an environment like this. Diagonal spreads. In fact, we actually did a couple in the options class. Let me show you the remnants. The first part of these finished phenomenally well, made like 60%. Now, if you look at SPY, I'm not worried about the diagonal. I still have a little more time. The diagonal looks great. I would love for this market to get a little higher. And I'm gonna roll this. I'm gonna close the one I have. I sold it. I sold this for $469. Right now, I could buy it back for $205. I could buy it back for $205, and then I could go sell the fourth. I could sell another one at $478 further out, and I could collect more money. That's a profit. I could roll it for a profit, but I still think I have the ability to wait a little longer. That's the diagonal. You'll notice the diagonal is theta positive, delta positive. It's bullish, theta positive. I make money from time. Vega positive. I make money if implied volatility goes up. So in that case, it's a bit of a hedge. This is the calendar spread. Right smack in the middle. Tomorrow, when I close this down, it's going to be for about $600 in profit. How much did this thing cost? I paid, let's see, 17 and 46, 57, 63. It looks like I paid 63 cents, $630. I've made almost 100% on this trade. What have I done with it? Nothing. I just sat on it. Literally just sat on it. So those are the types of trades that I like in this environment. I don't love vertical spreads, credit or debit. If I were to do one, I would do probably an out of the money debit spread, out of the money debit. I don't like butterflies or condors because the implied volatility is just too low. That's where I am. All right. Any other questions? I love it. It's great work. Get comfortable with charts. Get comfortable with charts. You should have your objectives. You should have exactly what you're trying to put together. Like I said, piggyback with me. I'll give you a great starting point. I'm happy with the charts that I have. Less is more, in my opinion, when it comes. I've seen people that have so many oscillators stacked down here, they can't see price anymore. And I'm thinking, it defeats the purpose. Let me get rid of this, back to my normal. And there's my normal. Price is king, oscillator. I don't have volume. Why? Because this is an index. If I go back to a stock, the volume will show back up automatically. There it is. All right. Fabulous day. Good to see everybody. Don't forget tomorrow's an afternoon session. We'll wrap this up. Are you working on SS that shows oh yeah. Wasn't there a matrix for that in the presentation Gary gave? I thought we did that matrix. I'm going to go into more detail. I hope he covered that. To be fair, I didn't watch the whole thing. I trust him. That's why. Let me see. Trading foundations. No. Options foundations. Where's the Greeks? Selling time option, key concepts, intro. There it is. Hold on. I'm going to look. I thought this right here. And this is the way that I go through it. I don't know if he went through, but real quickly, we have either low volatility or not low volatility. I'm not like, no, medium, high. It's either low or not. If it's low, Vega positive. That's buying calls, out of the money bull call spread, diagonal spread. That's directionally bullish. You're not going to be directionally bearish, typically, in a low implied volatility market unless you get it on very quickly, which is why bearish tends to be long puts, out of the money bear put spread. When I'm high, medium or high volatility, I'm going to do at the money bullish spreads. I'm going to short puts, covered calls. I'm going to do butterflies, iron condors. If we're in an established bear market, I'll probably do a bear call spread. This is mainly what I'm working with. I don't do a lot of the other fancy smancy, unnecessary option strategies. All right. Woo, good questions, good sessions. Great to see everybody. Have a wonderful rest of your night. I'll see you tomorrow afternoon. I'll see you Sunday. As always, happy trading.